So people got bought in anticipation of this event. And then when the news came, they sold, right? Gold couldn't make a new high above 5,500. And so the people who bought it at 4,900, 5,000, 5,100 took profits. Classic. And that's why the markets went down. But the reality is investors could ignore the noise and, if anything, just take advantage of the opportunity that the traders are creating, because the war is bullish for gold. It's bullish for gold, not just because it's bearish for the economy, but because it's inflationary.
With gold and silver already slipping as oil jumped yesterday, that trimmed the volatility and high-low losses for gold and silver investors trading in euros, UK pounds, and other non-dollar currencies. Market analysts suggest the bull run is intact, though the market is experiencing short-term chop and steep corrections. Renowned global exepert Peter Schiff emphasizes the market's reaction to the outbreak of war was surprisingly subdued. Schiff believes the pullback in gold was a classic buy the rumor, sell the fact move, with traders taking profits once the conflict became official. Recent reports show crude oil spiking sharply on supply fears, while safe haven flows initially lifted gold before volatility set in. Schiff argues that if inflation pressures build alongside fiscal deficits, gold could ultimately resume its upward trend despite short-term turbulence. Some analysts suggested conditions are in place for gold to make gains later in the week, including analysts at Fitch Solutions, who said gold could once again surpass $5,600 unless the conflict de-escalates. Regarding mining equities, Schiff notes that gold and silver stocks fell even more sharply than the metals themselves, despite being highly profitable at $5,000 gold and $80 silver. He argues the decline reflects short-term trading and profit-taking rather than any deterioration in fundamentals. Looking at the broader outlook, Schiff maintains that war is structurally bullish for gold because it fuels economic instability and is typically financed through inflation rather than higher taxes. In his view, long-term investors should look beyond near-term volatility and focus on the growing inflationary pressures building beneath the surface. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Peter Schiff's recent interview.
The market reaction so far has been very muted. You know, the Dow and S&P was barely down on Monday, right? Started Sunday night because the war started on Saturday when all the markets were closed. The only market open was Bitcoin, which originally sold off down to about 63,000. But then it bounced back and the stock market barely went down. Gold, which closed last week on Friday at about 5,250. Gold rallied above 5,400 initially, but it really couldn't make a new high. It didn't get above 5,500. Silver rallied, but I don't know if it got to about $95, $96 an ounce, nowhere near the highs. And then silver went negative on yesterday, and gold, lost more than half of its gains, and the stock market recovered. It was barely down. Now, today there was a bit of a delayed reaction. At one point, the Dow was down 1,200 points, but it closed down less than half that. And, it's down a little bit tonight, rather. I'm talking the Dow's off. Dow futures off about 150 points. But the Dow is still above 48,000, not that much below 50,000. The stock market has really not priced anything bad in. It's still priced for near perfection. The market is extremely overvalued. So the war is not going to be good for the market. And, even if oil prices go up a lot, we're not going to be able to have a meaningful increase in domestic output. The oil industry is not going to be able to ramp up capacity that quickly, and they're not going to do it unless they believe that the oil prices are going to stay high. If they believe it's just a short-term spike, they're not going to invest the money so that by the time the oil comes to market, the price has gone down and now they're losing money on every barrel because we're a relatively high-cost producer. We're already producing the low-cost crude. Anything that we can produce cheap, we're already producing. So if we have to get the more expensive oil, we're not going to do that unless the price is not only higher, but the oil companies have to believe that it's going to stay higher. So it might take a while for that to sink in if everybody thinks this is all just about the war and it's going to be over quickly. So we're going to be looking at much higher prices. Gold prices, after not going up very much yesterday, got killed today. Gold at one point was down, I know it was down over $300 or $250. But the interesting thing was it really held 5,000. I don't think gold traded below 5,000 today. Got close, but it didn't get below. And as I'm talking now, it's back at about 5,150. Silver got shellacked. I mean, it was down like $10. Silver has been very, very volatile recently. But as I'm talking, it's still about $82.70. So even though it's been very volatile, it's still miles above the old $50 breakout. Now, a lot of gold and silver stocks got killed today. They were down 10%, 12%, 15%. They cut those losses basically in half, but they shouldn't even be going down because $5,000 gold and $80 silver are prices in which these companies are massively profitable. And the profits are much higher than what anybody expected they were going to be a year or two ago. Yes, the prices are up, but they're not up nearly as much as they should, given the impact that these higher prices have had on their earnings and their earnings outlook. But the reason I think that you had this sell-off today and partially yesterday is just a classic buy the rumor, sell the fact. It was pretty obvious to everybody, which is why there was no reason not to have a vote in Congress. The whole world knew, including the Iranians. So there was no need, to worry about spilling the beans by debating a war in Congress. The reason that Trump didn't go to Congress is he was pretty sure that Congress would not vote for this war. So he had to just wage it on his own. But since everybody knew that war was coming in some form, we were going to do something, I think that a lot of traders bought gold, thinking, okay, we're going to attack Iran. That's going to be good for gold. It's going to be disruptive to the economy, the markets. I'm buying gold. I'm buying silver. So people got bought in anticipation of this event. And then when the news came, they sold, right? Gold couldn't make a new high above 5,500. And so the people who bought it at 4,900, 5,000, 5,100 took profits. Classic. And that's why the markets went down. Gold stocks, even more volatile. Maybe some people thought that the price of gold would go up if we attacked Iran. And so they decided to buy gold stocks. And when we did attack Iran, they sold those gold stocks. This is what traders do. But the reality is investors could ignore the noise and, if anything, just take advantage of the opportunity that the traders are creating, because the war is bullish for gold. It's bullish for gold not just because it's bearish for the economy, but because it's inflationary. Why is it inflationary? Because politicians always pay for wars through inflation. The last thing they want to do is make a war even more unpopular by asking the public to pay for it. Right? The politicians are not going to say, we're fighting this war and wars are expensive, and so we have to raise your taxes so we can keep supplying the troops. Right? People don't want that.
During the interview, Peter Schiff argues that the drop in mining stocks should be viewed as an opportunity rather than a warning sign. He notes that emerging markets have slipped as the US dollar index rebounded toward the 99 level, but he rejects the idea that this signals a durable dollar rally. In his view, the broader de-dollarization trend that began before the conflict is still intact and could intensify if geopolitical tensions undermine confidence in U.S. leadership. Central banks in parts of Asia and the Middle East have continued diversifying reserves, gradually reducing reliance on the greenback in trade settlement. Schiff argues that while the dollar may benefit from temporary risk-off flows, structural pressures tied to deficits, debt expansion, and geopolitical friction point to longer-term vulnerability rather than renewed dominance. Overall, Peter Schiff maintains a bearish outlook on U.S. markets and expects inflationary forces to intensify. Let's jump into the interview.
The mining stocks, again, sold off. A great opportunity to buy more mining stocks. Emerging markets also have gone down because the dollar's gone up the last couple of days. Dollar index is now back around 99. But I don't think this is going to be the start of a new bull market in the dollar. We were de-dollarizing before the war, and the world is going to continue to de-dollarize during and after the war. In fact, there's a chance that this war could diminish America's status in the world if it isn't over quickly. If the Iranians manage to hang in there and this thing drags out, I think that diminishes the power that we project. So we've got a lot to lose, not necessarily a lot to gain, but I would be buying the pullback in foreign stocks. This is an opportunity. I think all of my strategies, go to europac.com and talk to the representatives, look at my funds that have all pulled back as a result of this the last couple of days. But U.S. stocks, I don't think have dropped nearly enough. I think U.S. stocks were already overvalued before the war. And I think they're even more overvalued now that we're at war. Other than maybe the defense contractors, which benefit, everybody is going to lose as a result of this war. And so I would be selling U.S. stocks. But that doesn't mean you're getting out of stocks completely because you're buying foreign stocks. You don't want to hold cash because inflation is going to destroy that. And by the way, U.S. Treasury yields have risen so far. So even though there was a move into the dollar, that did not stoke a move into treasuries. So rates have moved up, not down, along with oil prices. So it's a bearish outlook for the markets.
Gold is expected to continue to shine as geopolitical situation remains very fragile with threats of further escalation. In such scenario, global uncertainty is expected to deepen and further fuel safe haven demand from the central banks, as well as individual and institutional investors. Analysts from UBS and JP Morgan see potential for even higher prices, suggesting the rally is supported by structural shifts. While most institutional forecasts center around $5,000 to $6,000 for gold and $100 to $120 for silver by 2026 to 2027, blue sky or aggressive bull case scenarios from several top analysts suggest significantly higher potential peaks. Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.